So now getting to your work, right? You've been on buy side, investing in different businesses. Would love to understand how this business works. Like, how do you make revenue?
Sure. Maybe I can just take a step back and explain how a private equity fund is set up, who the key stakeholders are.
Step 1, step 2, step 3. How do you build it first?
Sure. So a private equity fund is nothing but a sort of pooled vehicle where funds are pooled and you deploy that capital into various companies. So there are sort of 3 key stakeholders. One is called limited partners or LPs, which are essentially high net worth individuals, family offices, endowment funds, and the like, who have capital which they want to deploy in private equity style opportunities. And think of private equity and VC in the same sense because the structure is pretty similar.
They're just different stages.
Different stages of a company. After the limited partners come the general partners or the GPs. These are the people responsible for actually running the fund.
Today we have Vishesh Dalal with us. He's a close friend and a master in investments who has been an investment professional for the past few years, doing hundreds of deals. He's also been an entrepreneur in the past, which is super interesting and fascinating. And we'll get more into that. But welcome, Vishesh. Thank you so much for your time. Really appreciate it.
Thanks, Shantanu. Thanks for having me.
So before we get into anything, right, I think just to lay context, would love to hear about your journey from age 17, as you mentioned. How did you start your career? What were you doing? How did it come to where you are now?
Yeah. So like I told you, I started my career at the age of 17, joined EY while I was pursuing my chartered accountancy. Spent close to 6.5 years there, which really sort of helped me build the foundations of my career. Within the 6.5 years, spent time doing internal audits, business process re-engineering, kind of engagements with clients across a spectrum of industries. The other 3.5 years, I moved into the investment banking team within EY, where I was focusing on doing valuations and business modeling, which really gave me a deep dive into the world of finance, valuations, as well as modeling. Along with this, I was also doing my CFA from the CFA Institute US. And that helped me sort of build the other sort of fundamental and technical skills a finance professional would require.
So you were to do while you were working at...
I was, yes.
Okay, wow.
Yes. So both CA as well as CFA was something which I did on the job.
Oh, nice.
So at some point of time, I was doing my BCom, I was doing my internship with EY and was studying at the same time.
So you must be giving a lot of exams, right? Because I know CFA has a lot of exams.
So I would say, so 2009 through 14 were like one big exam a year kind of years for me.
Yeah. That's amazing. And then what happened?
So I spent 6.5 years at EY, and at some point I felt I needed to do something more. Back in 2013, my brother and I were remodeling our house, and we faced a nightmarish experience through the process, which led us to think, is there something we can do in this space? So in 2014, I decided to take the leap of faith into entrepreneurship, left my job at EY, and along with my brother, started a home improvement startup, essentially an e-commerce company working on a marketplace model, supplying everything one would need in a home or an office, right from plywood, hardware, bathroom fittings, light fittings, and the like.
Got it. And so just to be clear here, the marketplace model had buyers who were, let's say, homeowners or people in construction building the buildings. And the suppliers were suppliers of cement and things like that.
Correct. So the initial proposition was B2C, which means the C is people like you and me who are wanting to remodel our house and we need supplies to do it. On the supply side are essentially distributors of these products. So for example, cement distributors or plywood distributors or bath fitting distributors, etc.
So basically like an Amazon for building houses.
Correct. It's called a vertical marketplace where you're focusing only on a particular category rather than selling everything within the sun. But the point is to be vertical but go deep in it.
Got it. So you'll have a long tail. So you'll have as many different products as possible.
Correct.
So you'll be the one-stop shop for everyone.
That's right. That was the goal. So we did that for sort of 2.5 odd years. At which point I felt, I wanted some experience outside of finance and something which gave me a global perspective, which is why I decided to take the GMAT and then do my MBA. So back in 2016, I did my MBA from the ISADE Business School in Barcelona. Spent 1.5 years in, I would say, one of the best cities in the world. Especially when you're there as a student, it can't get better. And that gave me a deep dive into the business school skills which one wishes to learn, right? So I took courses on marketing, on corporate finance, on corporate strategy, leadership, which really helped me look at things from a very different lens. The other advantage of going to Europe over any other country was the diversity I found in Europe. So my school had a cohort of, say, 180 students coming from 49 different countries. So the kind of people you meet, interact with, and make friends with throughout the time you study and thereafter, I think gives a very, very different perspective. You learn about different cultures. You learn about how businesses in different countries operate through their experiences. Within that program, I also did an exchange. So I always wanted to sort of, study or sort of live in the Silicon Valley, right, in the US. So I did my exchange at the Haas School of Business in Berkeley. So it was a good 5-month exchange there. And the best part of that exchange was that I took electives on private equity and venture capital, where people who ran private equity and VC funds in the Bay Area actually came in the evenings to teach us. So that was sort of real life learning in school, which I got, which really helped me sort of hone my skills further in the private equity VC space.
Amazing, amazing. So this business school experience must be amazing, right? Because you've got exposure, you're seeing real deals. You're also learning a lot of different skills, right? Because you're doing marketing, strategy, etc. Do you think it was worth it? Do you think the whole business school was something that actually shifted your career, got you perspective which you would not have got otherwise?
I think so, because see, a chartered accountancy and a CFA is very finance oriented. So you're going deep into finance, whereas at business school, you are in a way sort of polishing different skills which you may not have had a chance to polish in your sort of formative years of your career. So things like presentation skills, working in teams, which are again multicultural, diverse teams, is something which one would not sort of get when you work and study in India. So I think that's something which really helped sort of build those skills and bring a global perspective to things. So you always sort of end up thinking that this is the scale of what I see in my city or my country. Now you start seeing and understanding how things work in different parts of the world, which I think is an extremely good perspective to have.
Got it. Amazing, amazing. But just to continue on your journey, because I think we have that flow, right? So then after that business school, what did you do?
So I was looking for buy-side roles or investing roles post my MBA. Like any MBA student, I networked really hard while I was there. And I figured someone in the alumni network who was in touch with this fund in Singapore, which was looking to hire someone. So that's sort of the networking route I took to getting an interview at a buy-side fund, which led me to spend the last sort of 4.5 years of my life in Singapore.
Okay. And then after that, you came back to India.
Correct. So I think post-COVID, obviously during COVID, a lot of us got the time to reflect and really think what we want to do for sort of the next decade or two in our lives. And I think through 2021, 22, it was getting clearer by the day that the future is India. And if you really want to build your career in India, you need to be on the ground. It's tough to sort of live in a foreign country, maybe look at investments in India, but doing it remotely isn't at all the same as being here. Like when you're here, you can actually meet with people in person, you can visit their offices, their factories, and the kind of sort of network building, etc., which one can make by being on the ground is something which sort of motivated me to make the shift back. And it's been over 1.5 years, and I think it's been fantastic learning ever since.
Yeah. And the India decision was solely based on the idea of growth in the market, or was it something else? Was it just growth that was driving it?
I mean, we felt that it's the right time to be in India for at least the next 2 decades, if not more. And the sooner we did it, the more we would be able to sort of use it. So both my wife and I moved back in middle of 2022. And it's been a fantastic journey, and I would say that it's just the beginning, because I think we are seeing all the right things happen for India, be it in terms of our growth, be it in terms of stable policies, etc. Which, I mean, the star seems to be aligned for us, and it's the place to be if you want to sort of build your career.
Got it. Got it. So before I think we get into the investment side of things, I'm very intrigued by all these professional degrees that you've done, right? You've done a CA, you've done a CFA, and there's a BCom in there, and there's an MBA, right? Would love to know what different degrees taught you, how valuable they were, and how would you recommend a young person, like an 18-year-old, look at his career or her career basis those degrees? Like, what should they strive to do first or later? How would you plan that for them?
Sure. I mean, I can share what my thought process was. So back in the day, I could start my CA right after 12th grade. So I would be sort of 16 or 17 when I sort of gave the first exam for CA. See, CA essentially focuses on sort of accounting, taxation, auditing, which makes you go really deep into understanding the financial statements of a company. So that's sort of you help. I mean, the final CA exam, you are supposed to build the profit and loss and balance sheet of a company from scratch. So that gives you sort of real ground learnings of how journal entries are passed, how that eventually rolls up into your P&L, your balance sheet, and the cash flow statement. So that gave me a lot of sort of technical skills, but more so at that age, the rigor one needs to go through while pursuing a chartered accountancy course. I think that helps more than what you've actually learned sort of on the academic side of things.
So when you say rigor, you mean like rigor for numbers? You mean like you just get detail oriented, or do you also mean like discipline in general in life, or both, I'm assuming?
So actually it's both, because you need to put in a lot of hours, about a lot of long nights to really sort of do well in that. As a consequence of that, with that discipline, you actually sort of build that attention for detail. You don't get sort of, get more energy and strength to do things, to push things along till the finish line, which I think helps anywhere in your career. It's like for a sort of a professional athlete, the more you train, the better you become on the field.
Yeah, definitely.
So it's something similar to that.
Okay. So that was CA, and then how was CFA different?
CFA again sort of helps in the corporate finance side of things. So once you know how things are sort of how financial statements are sort of prepared in a CA course, here you are actually looking at them and interpreting data, be it numbers, be it sort of qualitative data, and understanding what you can do with that data. A lot of courses in a CFA course are around portfolio management, around risk management, around ethics, which is super important. So it helps sort of add a layer to what a CA degree offers in terms of interpreting data and in a way taking informed decisions on the data, on the financial statements which you see. Along with that, it helps sort of develop the whole investing mindset, because there's a course on portfolio management which helps you learn how do you allocate assets. Like for example, if I have 100 rupees, how much do I put in based on my stage of career, the number of years I feel I will work, my liquidity needs, my risk appetite. I understand how much should I put in equity, how much should I put in fixed income, should I look at real estate or gold as an asset class, etc.
You think the CA may not be enough if you want to be an investment professional, right? You would need the CFA, like they go hand in hand.
I wouldn't. It's not mandatory. It certainly helps. I've seen a lot of people with CA degrees do exceedingly well in the investing space. It's, I think, how you use the degree rather than the degree itself.
Got it. And then, as you mentioned, the MBA just sort of broadened your sphere of understanding.
Absolutely. Think of it as a polishing school where you get to learn things which you've not sort of either learned in the workplace or in your sort of formative years of education. Things like operations, marketing, etc. Now, these are things you may not want to build your career in. But when you actually sort of take up an investing role and you invest in a company which has all these functions, you need to understand how those functions operate.
Yeah. It makes you run a business better overall.
Exactly. So it helps you, like the name suggests, right? It's business school. So it helps you learn how businesses operate, but not just from a strategy point of view, but also, like I said, operations, marketing, obviously finance, human resources, leadership.
Yeah, got it. No, super fascinating. So then after that, got into the buy side, right? So I think just to be clear, right? I think we would love to have you explain what is buy side, sell side, just like lay out the basics for us. Like,
sure.
for an investment professional, what does the structure look like? Buy side, sell side, what happens?
Sure. So the thing, let's say you are running a company and you need capital to grow, right? There are very broadly two ways you can get that capital. One is you go to the bank, you tell them this is your business plan, this is what you want, this is how you will sort of use it, and this is how you will pay it back. That's debt, or sort of the typical bank financing route. The other is when you're looking at, in a way, equity capital, which is also sort of risk capital, where you don't have to pay any interest on the amount which comes, but you share ownership of your company with someone else. So that's the buy side, which could be through VC funds, private equity funds. In the beginning, it could be through angel investors, your family and friends.
Got it. So
and
buy side is specifically for equity. Debt side is not called buy side at all, right?
Debt would be bank funding. So if you're more mature, there would be sort of bonds and debentures with which you could issue.
But that's not called buy side. Buy side is only equity funding. Right?
Correct.
Got it.
Broadly, yes.
Broadly. Got it.
So within the, sorry, you were saying something.
No, please, yeah.
No, so I think how different intermediaries, or what are the different players in this value chain. So let's say we take the example of you wanting to raise capital. You believe that you won't be able to pay interest at this stage because it's still sort of early stage for you, and you want equity funding to help you grow. So what you could do, right? You could sort of make up your business plan, which you mostly would already have in place. You would make a financial model of how you see yourself doing over 3 years, 5 years, and the like. If you have the right contacts, if you have the right networks, you could directly approach investors, angel networks, accelerators, saying, look, this is what I am trying to do, and this is what I want to raise capital for. That's sort of a direct route of raising capital. The other is you go through investment bankers, which is essentially what the sell side broadly entails, where they help you because they've done this for multiple companies in the past. They help you sort of formulate your story. They help you refine your business plans. They help you, put together an entire sort of pack in place, which positions you as a good candidate for funds to invest in. And through their networks, they help connect you with the right kind of investors who would be interested for companies of your stage as well as in your sector.
Got it. So they are selling you. That's why they're sell side in a way. Okay. And then, but they only do it at a certain stage, right? Or it can even happen in the beginning.
It could happen in the beginning, but in the beginning, typically your quantum of capital is too low. So it would not make sense to engage an external party to do it. You would typically do it through accelerators or, in angel networks, which have now been put in place, where individuals would be sort of investing anywhere between 5 lakhs to 20 lakhs, and you then pool it. Crowdfunding is another way of sort of raising capital. There are a bunch of platforms offering crowdfunding opportunities.
And usually, from what I understand, is to get into the buy side, you usually have to do the sell side first, right? But you didn't do that sell side. You didn't, or you had that sell side and then...
So I actually did do sell side at EY. Like the latter half of my experience in EY was something what a sell side analyst would do. I would think that's the sort of the more typical path of getting into the buy side, where you actually work with companies. You've done many deals throughout your sort of years at the buy side, at the sell side, and then you move to the buy side. A different route to doing it is through doing consulting. So the big consulting firms, a lot of those who've sort of spent the first, say, let's say 5 to 10 odd years of their career working in consulting, find it easy to make the shift to the buy side because they've worked very closely with companies on market entry strategies, on revenue optimization, on cost efficiencies, etc. So again, the consulting career path also prepares you for the buy side.
Got it. So are there only these two paths, the sell side to buy side and consulting to buy side?
I mean, you could start your career on the buy side as well. There's nothing which prohibits you to doing that. But I would imagine this gives you a good sort of learning. It gives you the right tools before you make the switch. Otherwise, you'll have to sort of, retrain yourself on a bunch of tools to come at par at the other people who've been doing this for a while.
And there are no other ways to get these tools, I would imagine, just consulting.
There are a bunch of courses. For example, financial modeling. You can go to any of the MOOCs and you can find a bunch of courses on financial modeling. But it's nothing similar to actually doing it for a real company.
Of course. No, lovely. I love that explanation about buy and sell side. I think a lot of people get confused in those two terms. So lovely for the clarification. So now getting to your work, right? You've been on buy side, investing in different businesses. Would love to understand how this business works. Like, how do you make revenue?
Sure. Maybe I can just take a step back and explain how a private equity fund is set up, who the key stakeholders are.
Step 1, step 2, step 3. How do you build it first?
Sure. So a private equity fund is nothing but a sort of pooled vehicle where funds are pooled and you deploy that capital into various companies. So there are sort of 3 key stakeholders. One is called limited partners or LPs, which are essentially high net worth individuals, family offices, endowment funds, and the like, who have capital which they want to deploy in private equity style opportunities. And think of private equity and VC in the same sense because the structure is pretty similar.
They're just different stages.
Different stages of a company. After the limited partners come the general partners or the GPs. These are the people responsible for actually running the fund.
So they're the operational people.
Who actually take investment decisions and who are responsible for operating the private equity fund on a day-to-day basis. And then there's the investment team, which is comprised of a bunch of analysts, associates, and vice presidents, which actually work on these deals on a day-to-day basis.
So they don't come under the GP? Then?
They do come under. So the GP and the investment team comprise of the people working within the private equity fund.
Got it. Okay.
And then so once you have capital sort of pooled in together, the next is how do you deploy this capital?
But how do you raise the capital? Like how does the raising happen?
A company would raise capital from investors, a private equity fund would raise capital from LPs. So you essentially talk about what the team has done in the past, the kind of deals they've worked in, the kind of success they've seen, the kind of sectors they want to focus on, and then you go and approach these funds who would want to be part of the next fund which this team wants to do. Got it. So you're essentially betting on, as an LP, you're betting on the investment team, along with the GP, of course, the sector or the space in which they want to invest. And a combination of these two is what you want to then back. And in which in turn they back into actual sort of, operating companies on the ground.
And as you mentioned, LPs are of different types, right? They're like...
Correct. So it could be, even you could be an investor in a private equity fund. Some funds do accept you need a minimum of 1 crore based on the rules today to be part of an AIF and invest in a PE fund. But I think the larger pool of capital sits within sort of wealthier individuals, family offices, and a lot of endowment funds. If you are even larger than that, you can approach the sovereign wealth funds in the Middle East or in Norway, and those could be your investors.
Got it. So yeah, that's the first step of building.
Correct. So you set up a fund, you've raised capital which you now need to invest in. Typically funds come with anywhere between 5 to 10 years life, which means that you need to raise funds within the sort of first year or so, and then your sort of timer starts where you need to deploy funds. Funds typically like to deploy the capital they have raised in the first 3 years after raising. And then you have a period of another, let's say 5 odd years to exit those investments.
Got it. And these are sort of fixed?
No, so you can define your own sort of investment tenure.
But in the sense, when you're raising money, then you sort of fix it.
You need to commit. You need to say that this is how you wish to, operate. These are the timelines one needs to look at.
Got it. And so that's the first step of building the fund, raising the money, right? And I'm assuming the second, or I guess even before the first step, the important step is to build that team.
Correct.
Right. So how does one look at building that team? Like, what do you look for usually?
So, like you rightly said, I think building the team is the next most important step. You would typically want to work with people who you've worked in the past, or if you're actually setting up a new team, you actually look for people who have experience in the same sectors in which you wish to invest, be it on the sell side or in other buy side funds.
Got it. So let's say if some professional or young person wants to get into a team like this, right? You must be interviewing people. What do you look for in them?
So I would say learnability is a key skill we look at, because see, the whole space of investing is you're taking a call on the future. You don't know what will happen with the company. Along with the management team, you need to help create a future for them, which means you need someone who is willing to learn, is agile in his or her views and opinions. Like Jeff Bezos says, right? Hold your strong opinions weakly.
Yeah.
So you need to have strong opinions, but they should be held weakly, which means if someone else has an opinion which differs from you, but that person needs to take the call, you need to sort of agree to disagree and take it from there. So I would say the finance skills, modeling skills, etc., are table stakes when you look at hiring people. It's more of these softer aspects which you really sort of, or which at least my team and I look at when we add people to the team.
So the other finance skills are base. You need to have that.
They are table stakes when you're talking about
it. And so then I guess it becomes really important to build this culture of openness and disagreement, right? Like how does one do that? Because that's super hard, right? Like
that is. So I think the large part about sort of day-to-day operations is you work very closely with the team. You create an atmosphere where people are, open or happy to share their views. Even if they may be wrong, you sort of encourage them to share their views. At the same time, you help people sort of take decisions because not everyone would have done this before. So you help them through the process. But you just create an open environment where people actually are forced to contribute to discussions rather than being listeners to a conversation. Again, like I said, you're creating something for the future, which is uncertain and unknown. So you need to work as a team. You need to put all the traits which a team would have together to make these decisions and eventually make the decision and then work with those portfolio companies to help create value for them.
Got it. So if I'm looking at it from, let's say, a recruitment side also, right? How would you judge all this, right? Like when you're actually looking at, let's say, learnability, do you ask some questions in the interview? How do you like really judge a person for these softer skills? Because the hard skills, you can see the degrees.
Correct.
Or you can see experience.
Correct.
How would you judge for all these softer skills?
So one proxy to, at least the way I look at it, is that you can ask about sort of books they read, right?
Books they read. Interesting.
Outside of their core area of expertise. So if let's say I am in the investing space, I would have read a bunch of books from Warren Buffett, a lot of other finance authors. Are they reading things outside of their core area of expertise? Which helps them sort of develop their thinking. Everyone reads, say, Economic Times or, Times of India. Do you read sort of the Wall Street Journal? Do you read the Financial Times in the UK? Which gives you perspective outside of what you are reading and seeing in your sort of space in the country. And it helps challenge things because you start thinking that X thing works in a different way in another country. Can something like this happen in my country at some point of time? So although we would focus our investments in India, it's important to have the prism of learning of what's happening in other countries as well.
Interesting. So actually, I'm intrigued here because when you said whether they read books, I sort of assumed you meant a variety of books. Because, for example, every subject has its mental models, right? Mm-hmm. Biology has its evolution, right? There's a mental model there. So I'm wondering if you guys also look at that this person has different mental models to look at a problem. So is that reading also important, or did you just mean it's finance reading in different industries and different markets?
Actually, what you said is absolutely true. Mental models and how one can connect dots.
Okay. Got it. So it can be other subjects that...
Absolutely. It actually should be other subjects which help you sort of connect dots, saying not just the XYZ thing happening in another country, but in another domain, like you said, biology, right? Something happening, or history. A bunch of learnings from history. History always sort of repeats, right, at some point of time. So I think that's another important skill, to have that kind of diversity of knowledge. And the other thing is to not, like I said, right, hold strong opinions weakly. I think Mark Twain had a fantastic quote which said that it ain't what you don't know that is the problem. It's what you know for sure that ain't true. So you need to sort of have that kind of openness of mind to be able to accept that all your decisions may not be true. You need to sort of learn and leverage on other people's learnings as well, rather than be fixated on your own.
So I'm very intrigued by all that you're saying right now, right? And I'm very intrigued to know that how do you do it? Like for yourself, for example, in terms of diversity of reading, what else do you read to make sure that you can connect these dots? Like, what is your reading?
So it's a mix of, for me, it's a mix of reading and meeting people. I think the more people you meet, the more you learn from their experiences and the way they look at things, be it your peers within the industry or outside. Within reading, I obviously like reading a lot of finance books, but I also like reading a bunch of autobiographies because that gives you an insight of how that person has sort of built their career, be it a sports person, be it a business person, whatever, right? That doesn't really matter. And human behavior, absolutely. So there's a fantastic book by an author called Morgan Housel, which is Psychology of Money.
You've gifted it to me.
It gives a fantastic perspective of money, right?
I love it. It's a great
and there are so many good blogs available on the internet which constantly challenge the way you think about things.
Yeah. So, because I'm just intrigued by this learning process, right? So, apart from books, do you have and meeting people, do you have other sources of expanding that curiosity and learnings? Like podcasts, for example, because...
Absolutely. So podcast nowadays has become like a big learning tool. And thankfully, because of the traffic in Bombay, one could get so much more time than outside of the workplace. So I think that's again a very important tool, and a bunch of really good podcasts are available where people have open conversations and you learn how they think. I think this whole business is about understanding how to think and then eventually taking decisions. So you would have heard of Charlie Munger, right? One of the best investors along with Warren Buffett. He has a 4-part framework for life. He says one needs to sort of focus on these 4 things, which is preparation, discipline, patience, and decisiveness. So these are sort of the 4 things. He says that if you can figure out these 4 things and stick to it for long enough compared to anyone else, you would really be able to do what you want to do.
It's preparation, discipline,
patience, decisiveness. So in ancient Greek, there's a word called kairos, which means the opportune time. So decisiveness goes very closely with kairos, which means that when the time is right,
you hit the hammer.
You need to be prepared to hit the hammer.
Yeah. But you need discipline to be like, be on the lookout for the time and like be prepared.
Absolutely.
Got it.
And you need preparation because without being prepared, you won't know when the time comes.
Got it.
And you need to have patience for the time to arrive.
Because you're playing the long game.
Exactly.
Right? Investment is a long game.
Absolutely.
Got it. No, I love it.
So there's another very interesting a blog and a video by a Stanford professor called Graham Weaver. He says there are 4 principles which help you live an asymmetric life. Okay. The first thing is do hard things, which means do uncomfortable things, which really help you grow. Second is do it long enough, or let me just recollect the exact one. It's first is do hard things. Second is do it for decades, which means that you need to have the patience and the discipline to keep doing it over and over again for a long period of time. The third is do your thing, which means everyone has their own sort of unique thing, right? We are all great at something. We just need to figure out what it is. And the fourth is write your story, which means that every day you have an opportunity to write a new story.
Yeah. Oh, I love it. I really love the part about long-term thinking here, because I think a lot of times we forget that, especially in the world where everything is about like quick gratification and stuff, right?
Yeah.
But it's discipline for the long term that really creates impact. And I think...
Absolutely. And that's where sort of compounding comes into play, right? You would have heard that compound interest is the 8th wonder of the world. I'll give you a quick, simple math, right? Imagine that you are earning, say, 15% return on your capital on a yearly basis. How much do you think your money would be in sort of 5 years' time?
So I sort of know the math. It'll double.
Correct. So it's double in 5 years. It'll be 4 times in 10 years. It'll be 8 times in 15 years. And it'll be 16 times in 20 years, broadly. Now, if this 15 becomes 20, what do you think you would end up with after 20 years.
So it'll double every 3 years, right?
Correct. So out of 20 years, you'll end up with some 38, 39 times your money. Again, here it's not the percentage which matters. It's the amount of years you can earn that income over is what really creates this compounding. So it's not linear, which is how our minds are trained to think. It's parabolic after a point.
And you know what I think? I think interestingly, this compounding argument works in life for everything. It's not just finance. It's even friendship. It's like health. If you go to the gym every day, it compounds.
Yeah, you just need 1% improvement every day, right? For you to be incrementally better every year.
So I love that. I love that. And I think you're right. Investing does build that mindset, right?
Because you hardly or rarely see results immediately. There's always a long wait involved with a lot of ups and downs through the process.
No, I totally agree. I'm actually very interested to ask you, like, you know how currently there's a whole bull market and everyone's getting like quick returns and everything, right? And it's very hard to maintain your discipline and, you know, your long-term thinking in this market. But how does one do that? Like, do you still just follow your basic principles? You stick to that, and as a personal investor?
So I would say that, investing is done right when you follow a process and a philosophy, irrespective of what is happening around you. So maybe optically things may be looking sort of extremely overheated, but if your process suggests that there are still opportunities available in the market, there are still opportunities available. So that's, I think, one of if things look sort of in a sort of bubble manner at this point, there could still be good opportunities available even in such markets. But I think the other side is that a lot of people today haven't really seen a bear market. Which hasn't happened because there's been super low interest rates right from 2009 in the US. So there's been at least a 12, 13 year period where things have only gone north. And a lot of investors haven't really seen that bear market which was prior to that, where for years one would not make money if you were to sort of look at sort of very broad numbers. So to be able to make all your decisions based on 3 years or 4 years of you investing and finding success will work for some period of time. But I would sort of exercise caution over thinking that this will continue forever.
That's where you need the history, huh?
That's where history. And that's where a lot of books really help you learn history of what happened in the past, and that you could draw parallels of what may happen in the future.
So I'm very intrigued to know about personal finance. Also, I think we'll get to that. But we were already talking about the business of PEVC, right? How do you build that business? And I think we were at the team building stage. Would love to learn more about the next stage, which is, I guess, actually sourcing deals, actually looking at companies. How does that work?
So before we get there, maybe the commercials or how the economics for a private equity fund work. So there are two components to how revenues flow into the private equity fund. One would be fixed fees, which could be anywhere between sort of 1.5% to 2% which is if, let's say, X rupees is committed into the fund, X into 2% is the fee the fund charges to its investors on a yearly basis.
Got it. So the fees coming from the investors.
From the investors. That's the pool of capital you are managing.
Got it.
So that's where...
That's for the operational team.
That's for your salaries, your basic infrastructure, compliances and the like, operation costs. And then there's something called as performance fees or carry, which is as you exit investments which you've made, based on the return you get, you could get anywhere between, let's say, 15 and 20% as performance fee. So it's called the 2 and 20 structure, where you get 2% fixed fee and say 20% performance fee. In some cases, above a particular hurdle rate. So let's say the first 10% goes directly to the investor, and returns above that are split 20-80 between the fund team and the investors.
And I'm assuming the hurdle rate generally would be basis the market, right? So if the market is giving you 7%,
correct,
the hurdle rate would be around that or whatever.
Yeah, 7 to 10%, 15% in some cases. So it's a range.
Got it. So that's how...
So that's the economics, right? Then we get to what does this team do after it has a pool of capital. So the first would be sourcing transactions. So we talked about the buy side, we talked about, investment bankers. So these are sort of different channels through which deal flows into a private equity fund. One is investment bankers. Second is a lot of accelerators, angel networks who've done sort of the first round, and now the company is prepared to go and do the next round of funding. So those could be sort of another conduit of getting transactions. Second is a bunch of investors who are looking at co-investors to invest in a particular transaction. So as you spend more time in the space, you obviously build networks of peers who are doing something similar through their own funds. And you develop that network through which new transactions or new opportunities to invest in come in. So I would say on an average, a fund would be looking at anywhere or would be getting anywhere north of sort of 300 plus opportunities on a yearly basis, out of which you would do a preliminary sort of analysis on maybe half of them. You would do something more deeper where you spend time and sort of create something called as an investment memo, which goes into your investment committee and do for, let's say, 30 to 40 of them and 10%. And eventually you would end up investing in maybe 5 or 10 companies at best. Now, again, it depends on the stage of investing for your fund. A private equity fund would do fewer deals. A VC fund, which is focusing on more early stage, would end up doing more deals.
Yeah, because the risk is higher.
Your risk is higher, so you want to diversify across different opportunities. And you're investing in much more early stage companies. So you would want to sort of, spread your bets there.
So I'm assuming early stage companies are harder to assess, right? So
they are, because a lot of your assessment is on the team and the industry. The first thing you look at is the industry in which this company is operating attractive enough, right? So something called as a TAM, right? The total addressable market. Is this something which can scale? See, you're not betting on the company today. Any investing decision is taken on the future. What do you think this company can do, let's say 3 years from today, 5 years from today, 10 years from today? So that's sort of the lens through which you are looking at opportunities. So one is okay, I've figured out an industry, it looks attractive, it's something which I understand, because for investors, it's important to remain within your circle of competence, both in terms of stage of investments and in terms of industries in which you would invest.
So just to clarify, because I understand what circle of competence means, but I think it's a very important concept, right? Like, can you define it more for us? Like, what do you mean by circle of competence?
So let's say you work for a sports tech company, right? You've spent a few years with them. You know how the business economics for that work. Apart from that, there are a bunch of allied industries, sectors, which work on similar business models. So you understand those business models very well. So that essentially, by virtue of spending time in a particular company and by understanding business models of that company compared to other similar companies, you create something called as things you understand better than others. That's where you want to sort of, then you're comfortable. If I come up with an opportunity that I want to start another sports tech company, you know what works, what doesn't work, how long it'll take, what kind of obstacles one would face. So you start creating that. Now, you would start off with a smaller circle for sure, because you can't learn everything from day one. But over time, as you get exposed to more industries and the more investments you make, you tend to sort of expand on that circle of competence. But again, it can't be something which is infinite. It'll be difficult to be a generalist where you can have expertise over each and every industry in the country.
Yeah. Though, would it be easier to do it at an earlier stage? Like, if you're an early stage angel investor, then you probably are able to spread out.
More spread out,
Yeah,
correct. And as the businesses become more mature, the investors who invest in it will also sort of focus on those kind of companies.
It becomes more specialized as you go up.
Got it. Because the quantum of capital you invest in a particular opportunity is much higher.
Got it. So yeah, just getting back to this. So you would first understand the industry, whether it's going to grow.
Correct.
TAM would be your basic analysis, but anything else you look in the industry?
So
like, is it like...
if it's early stage, it's the Of course. And that's part of the TAM, right? Whether, the typical sort of analysis you would do of an industry. And that's something which funds will have in their sort of investment philosophy thing. These are the spaces we understand. Let's say I would look at something which is in consumer financial services and let's say SaaS. Okay. So these are sort of 3 industries I would say I would understand, I would want to invest in. And companies which come who want to play in that industry, something I will spend time looking.
Got it.
Okay.
Yeah.
So that's sort of the first step of this thing.
Yeah.
Second is because it's, let's say, early stage,
Yeah.
you're essentially, trusting the founding team to execute on what they plan to do. So again, it's a bet on the people you want to work with.
Yeah. So then you've analyzed the industry. Now you're analyzing the company. In the company, if you have to break it, of course, there's people, and then I'm assuming there's product or whatever. How would you analyze these two things? Like, what are you looking for, let's say, in the product first?
Right. So, assuming this is a company where the founding team is in place, they have a product or a service or a solution which they're already selling, right? So, assuming these building blocks are in place, so it's not on a business plan stage, it's a bit more mature than that. And you are not, they make revenue, right? So, the first thing you would look at is that how much can this revenue scale and what will it take for them to get to that scale?
Got it. And are you looking at the sales? Is that the most important thing, or is it more sort of profitability?
I'll get to that. So I think first is potential of revenue to expand. I think that's number one. Along with that, will your economics, which means your sort of profitability as you get there, expand or not? It is unlikely that you will spend on customer acquisition the same way when you were at revenue of 10 as you would spend when you are at of revenue of say 100 or 200, right? There has to be some efficiencies which get built in as you start scaling. There has to be repeat customers which come to your platform. There has to be some kind of brand loyalty which builds in. And these can be evaluated through all these, operating metrics which we are talking about, and things like pricing power, right? So are your gross margins, strong enough for you to sort of scale? Will your gross margins remain at this level as you expand? Will they actually expand as you grow? Because there is a bunch of economies of scale, etc., which comes in. People want to work with you compared to you today going and finding people to work for, etc. So there are sort of qualitative, operating, and financial metrics one can look at to understand maturity and scale of a particular company.
Got it. In your experience, I know this is a hard question, but what has been the most important metric that has worked for you as an investor?
Okay, I think there's not one brush you can paint this with, because it's different for different industries. For SaaS, it would be something like repeat customers or customer lifetime value. It is absolutely industry specific. I mean, the typical profitability, etc., you could understand broadly, but you have to go deeper based on the industry you are trying to analyze. For retail, if let's say a company has always done D2C, right? They've sold direct to customers through the online channel and now want to expand offline. And let's say want to start stores. For each store, you want to understand what are the unit economics at a store level. How much do you need to spend? How much do you need to put in working capital? What is the revenue a store would earn? What is the margin a store would earn? And what is the payback period for a store? So, and you can then benchmark to other companies. And that's where a lot of understanding how the larger listed companies operate helps, because you can draw parallels saying, let's say I'm starting a apparel retail chain and I'm going offline for the first time. There are a bunch of larger guys doing it for many years. You have publicly available data for them. You can benchmark metrics from the public peers onto your private peers and understand that a scaled company can operate at X. Does this company who I'm sort of wanting to work with and back have it in it to sort of get there? And again, a lot of these metrics you will not see on day one or even in year one, because they will evolve. And you don't even know who the customer is in many cases and how frequently would they come back. So it's a process of working with management teams, empowering them to take decisions, some of which may go right or wrong, but it's again a lot of trial and error which goes into building a company.
Got it. So that was the product side that you would analyze. But then you would also analyze the team, right?
Correct.
So then what are you looking in the team? Like, what is important?
So I'd say, again, it's more softer aspects than technical aspects. Obviously, if it's a tech-focused company, if it's running a website or an app, you obviously need a strong technology team. But if it's actually running, let's say, a consumer company, do they have experience of, let's say, working in another sort of larger company after which they've left their jobs and started this? Or have they done this before? Which is why what we focus on is more on the later stage, not the super early stage. In the super early stage, you're actually backing the person, saying, I think this guy is or guy or girl is extremely motivated, knows what they want to do, and I want to back them with limited operating history of that particular company. For later stage, you have the benefit of some kind of track record which you can sort of work with, and you need to spend a lot of time with that person, getting a lot of comfort of working together. Because let's accept it, as a fund, you're becoming a part owner of the company. It's not that you're a lender and you don't care about what happens in the company. You are actually working very closely with them, and some of them you even have board seats, which means some of the decisions of the company need your approval for them to proceed. So you need to have that sort of comfort and operating, cadence with that management team and founding team.
So then you assess them on these skills also, right? That how well they will work with us, with our team, culture.
And intersay between the founders, how they've met, how much time they've spent together, how they've gone about building their team, how they're trying to build the culture of the company. Because those intangibles is what helps in the long run.
Yeah, absolutely. Absolutely. So once you've done the analysis, so after sourcing, you do the analysis.
Correct.
And then you invest in the company.
Correct. So you would give something called as a term sheet, which essentially is a heads of terms, which means this is the company, this is the quantum I want to invest, this is the valuation at which I want to invest, and these are a bunch of rights which I want against my investment. There is also a step of diligence where you would typically hire third-party service providers who would do, let's say, a financial diligence, a commercial diligence, a tax diligence, and a legal diligence. And in some cases, you also do an ESG diligence if the mandate of the fund requires so. So this is external validation to confirm that all the basic building blocks of the company are in place, what they've been sharing, data, etc. is all kosher, and you want to sort of take it to the next level. And then there's something called an investment committee of the fund. So once diligence is cleared, once you feel comfortable with what the company has been sharing, etc., it goes to the investment committee of the fund, which then takes a decision whether to invest or not. And then the post-deal management process starts, wherein you work closely with these companies, be it monthly or weekly, meetings on performance, operating parameters, and depending on how much you want to get involved and how much the company needs your inputs, you decide the kind of engagement accordingly.
Got it. So, but that can vary, right? It can be very operational heavy. Like a VC could be very operational heavy, or they could be very passive also, right?
Correct. So there are two ways to do this, right? Some funds come in with something called as operating partners, which means executives who spent time working in larger companies in their careers, and let's say are now in their, let's say, 50s or 60s and want to work as operating partners with funds. They will bring in the right operating expertise into these companies. Other funds purely work with the investment team, sometimes hands-on, sometimes hands-off. It again depends on how much the company needs you. Like I said, investing is, or rather private investing is a partnership between the provider of capital and the company which is getting the capital. You need to work very closely on different initiatives with the end goal being aligned that we want to create value out of this investment. Because if value is created is when a fund will make money out of it, of course.
Okay, so then the investing has happened, you manage it, let's say for whatever the years that you have to manage, and then you have to exit, right? How does that exit process work?
Okay. So I think there are sort of three broad ways in which one would get an exit. If the company has grown to a large enough scale, one could IPO, do an initial public offering, which is essentially list your company's shares on the stock market. The second would be selling to a strategic player. For example, you're running a D2C company and there are a bunch of large companies in that particular space. Let's say you're making chips and there are a bunch of companies. Yeah, you have, strategic players willing to take you for your brand, for your distribution, for your product, for different reasons. And then there are other sort of late stage, let's call them private equity funds who focus on late stage opportunities, who could also be potential acquirers. Saying that you've taken the company from, say, 1 to 50. The company still needs to go from 50 to, let's say, 150 before they go to the capital markets. There is another set of pool of capital who is willing to support those mature companies and take them to their next stage. And some of these funds even participate post you list. So they even participate in sort of doing private investments in public entities, which is called as PIPE, PIPE.
Okay. Got it. So then that's how the exit happens, and that's how the fund makes the money back.
Correct. So you get the money back through one of these three routes, and then you distribute it to your limited partners.
It was super fascinating. And so this is, you've been in this for 4-5 years now, this side of it. So you must have seen some exits, you must have seen some.
Yeah.
Would love to hear more about your general experience about that. Like any interesting things that you saw.
Again, I would say it's a process. It takes time to get an exit, and it's one of the most sort of difficult parts of this journey, because you need to actually get the company to the scale where it would be appealing to another set of investors, be it in the public markets or the private markets. It needs a lot of preparation, because operating as a private company is very different from operating as a public company. You need much more rigor, lot more compliances, etc. to do that. So I think it's a process. It takes its own time. And typically, I mean, an average life of investment for a private equity fund would be at least, or rather a private equity fund investment would be sort of north of 4 to 5 years. It's tough to, put in money and get it back sooner than that.
Yeah, makes sense. So this is amazing. I love the whole explanation. It was very clear. I love the whole step-by-step that we went through. So I'm actually also very intrigued about your personal investing, right? Like I would love to understand what is your personal investing philosophy, if you don't mind sharing. Like, is it just psychology of money?
No, not really ETF. I mean, I would like to believe that, active investing still plays a role in what, one, as part of your sort of asset allocation. I think people in their 30s, and given the kind of runway one is seeing for India as a country, I would imagine, being more heavy on the equities side would make more sense over the long term. And long term would be north of a decade, not anytime sooner than that. Again, it's nothing to prescribe. Everyone has their own sort of asset allocation frameworks and liquidity needs which they have. But it would have to be sort of long term investing. There is no sort of quick money as far as in investing is concerned. And there is a lot of luck involved in this process. It's difficult to discount that aspect of things, which is not quantifiable, which the more you prepare, the more discipline you have, the more lucky you get.
Yeah, for sure. But do you think active investing is still something like doable, something that will actually get you the extra?
I would say it depends on the kind of time you have to do it.
Yeah. If you don't, then do passive.
Because not just passive. There are a bunch of mutual funds, PMS schemes, AIFs, which again have professional managers managing that capital. And you would rather leave it to the experts than do it yourself if you don't have the time. But at the same time, I think learnability is critical. One needs to know what's happening in the economy. One needs to understand about what companies are doing and be able to understand where their money is being invested. I think that's important. But if you don't have time and you just want to have keep your capital invested in equity and let it grow over time, I think you would be better placed going through professional money managers.
What are you most excited about in India? Like in terms of a sector or industry, what is exciting about India right now?
I think consumerism, which we are seeing in the country, is fascinating. Post-COVID, we've seen like a K-shaped recovery where, there's a lot of premiumization that is happening. You're seeing more luxury cars being sold, more luxury watches being sold, the high-end brands selling more than the sort of mass market brands, etc. It's a consequence of discretionary income going up. And I think that is just going to, as formalization increases in the country, as we move from unorganized to organized sectors, as there is more jobs being created, the discretionary income will keep going up, which means that the amount of money you have to spend outside of your essentials is expanding. Think about it, right? Like we see so many kirana walas on the streets. Yeah. Do you really think their next generation would want to run that store? Probably not, right? They would want to study, they would want to work in formal jobs. And once you are in a formal job, you have access to credit. With access to credit, a lot more consumption happens because now you don't have to pay everything upfront. You can actually break it down in installments but still get access to that product, which is what we are seeing playing out in all the sort of mobile phones, consumer durables, etc.
Yeah. It's interesting. I was actually reading this that, if you're a $3 trillion economy right now and you go to a 6 or a 8 or 10, whatever it is in 10, 15 years, most of that addition is going to be disposable income, right?
Correct.
So everything about consumerism is going to increase because that addition is all going to disposable, or a lot of it.
Exactly. And not all of it is going to be saved. One, I think post-COVID, a lot of psychologically, I think people have started thinking that you only have one life. So I think consumption has gone up as a trend, and at least so far we are not seeing that reversing.
Got it.
And that's something which can go on for decades, because the next generations are going to be more prosperous than us. Which means that, we should not bet against our country. I think that we have the largest sort of people in the workforce. We have the perfect sort of, median age of the country at this point. Fortunately, we have a lot of policies which are now in place, digital payments, etc. You go to any small city, you would see people accepting money through QR codes. So the ease of doing business through all these small steps, I think, has become much better. So starting a business today in India is sort of, I would say, 50 times better than starting it sort of 10 years back.
Totally agree. Fascinating, man. I love this conversation. I learned so much, especially all the learnings about, preparation, discipline and everything, and the whole BVC market.
Yeah.
Wonderful conversation. Thanks so much. I think I have covered everything I had on my agenda. Yeah, man, Vishesh, thanks so much. This was lovely doing this. Thank you for your time and insights.
Thank you so much. Thanks, Shantanu, for having this, and all the best.